Namaste, good morning. Session 4. The intention is to complete the major part of international taxation. Okay, the intention is to complete the balance in NR, DTAA, AAR and Equalisation Levy. Let's see as the class goes by. So, we were looking at yesterday into NR taxation, okay, and if you remember our discussions on NR taxation, we divided NR taxation on the basis of following arenas. We did residential status, especially the poem concept. We did scope of taxation. We understood section 9 at its length and breadth going headwise. We are in the special rates of taxation. We are in the special rates of taxation where I was telling you that your memory power works much stronger in this arena. I asked you to remember 115A to a larger extent and the FII. Okay, so that should be clear. The next part of NR taxation is said in section 44. The next part of NR taxation is part of section 44. If you look at 44 as a section, it is administrative provisions. 44 AA, book maintenance. 44 AB, the reason for you all to study this course. 44 AD, presumptive computation for small business associates. 44 ADA, presumptive computation for professionals. 44 AE, presumptive computation for people who are having vehicles, carriage of goods. And then actually the chapter moves towards non-residents. There are some presumptive taxation for non-residents. Apart from the presumptive taxation, there are 3 arenas of presumptive taxation set for non-residents also. Apart from that, there are 2 other sections which are also of importance. 44 DA speaks about computation of income of royalties, income earned in the nature of royalties for non-residents. 44C speaks about head office expenditure allocation to the Indian branch. Okay, so our understanding starts there, and whatever is the remaining questions in the non-resident taxation, we will come back and do after completing this. First, on the presumptive taxation, presumptive computation front. Non-resident shipping business. Interestingly, this provision is spoken about in section 172 also. In section 172, when will assessment year and previous year be the same? normally in our tax law, first previous year followed by that assessment year. After the end of 31st March, from 1st April, assessment year commences. But in some cases, where the lawmakers is of the opinion that revenue might be lost if I wait. If I wait, the revenue might be lost. They are one and the same. Income will be assessed in the same year in which it is earned. Persons leaving India for the purpose of employment with no intention of coming back, income till the date of their leaving will be computed and taxed immediately. If AOP or BOI, which are more like joint ventures, and the purpose of forming is over, they are going to split or they are going to dissolve, then I will not be able to find a person and tax him. So till the date of dissolution, I will compute the income and subject it to tax immediately. I will not wait for the year to get over. If a person is trying to sell off assets because the department will go and seize the assets with the intention of avoiding payment of taxes. A person is trying to transfer asset with the intention of avoiding payment of taxes, then till the date of sale, I will ask him to pay the tax. I will not, he cannot say, no, this year only capital gains has arisen, next year I will pay till the date you pay. Like that. One such provision is non-resident shipping business. A ship belonging to a non-resident, if it visits any of the Indian port, repeat, a ship belonging to a non-resident, if it visits any of the Indian port and earns income, ship is owned by the non-resident, visits the Indian port, earns income. If I leave the ship outside, neither the ship nor the person is under our control. The person is a non-resident. The ship, if it leaves Indian territorial water, it will not be in my jurisdiction. So what I will say is, pay the tax, take the ship. So that is the provision under section 172. So both the provisions speak about non-resident shipping business. It has income from carrying goods, passengers, stock including livestock, mails will be covered, and also it will cover demurrage and handling charges. Because in the port they will charge it, handling charges, demurrage charges, everything they will collect from the customer. On this, 7.5% will be in both the provisions, section 172, be it section 172 or 44B. In both the cases, 7.5% of gross receipts. Once more, 7.5% of gross receipts will be treated as income. Here it is a normal computation in the sense after the year is over. For a regular person, they will have this. One time if the ship is coming, they will go for 172. Otherwise, the 44B is the better provision. Because here you can claim all deductions. There you cannot claim anything. All deductions means other than PGBP. Loss and all those things. If it is airline business, 5%. If it is airline business, 5% of gross receipts. If it is airline business, 5% of gross receipts. If it is letting out plant and machinery, 10%, and civil construction, 10%. These two are not very popular questions. These two are not very popular questions. These are very popular questions. The others are very popular questions, whereas these two are not so popular questions. Okay. So, PGBP, in our regular study, what we do, we stop with 44 AE. 44 AE is presumptive computation for plying of goods vehicle. And then 44B onwards, it is non-resident taxation. That's why we stop it there and continue it here. In our, we are now in our classroom. Fortunately, we are going on a reverse manner. So, up to 44 AE, we will cover in PGBP. From 44B, I am already covering. Okay, non-resident shipping business, non-resident airlines. These two are important. Remember the percentages. The other two just have a marking. That's enough. Now, generally we all know that if the head office is outside India, the head office does not perform any operation. They just do the administration and management of branches. Repeat. Head office does not perform any operation. They are doing the administrative and management for the branch. So what happens? The head office does not have a standalone income. They will say, my expenses, I will allocate it to various branches, which is acceptable, which is proper also. But this should not be used as a loophole. This should not be used as a loophole to allocate more expenses to countries where tax rates are high and less expenses to countries where tax rates are low or nil. There should be some equitable. So, income tax law of every country says what is the maximum head office expenditure which can be allocated to the branch. And the law is very clear. Because of that expenditure, I am not ready to take loss in my country. Okay. This is for a branch office of a foreign company and the branch is located in India. The administrative and management expenses can be allocated. Maximum shall be actual expenditure or 5% of adjusted total income, whichever is less. Maximum shall be 11. Maximum shall be actual expenditure or 5% of adjusted total income. Sorry. Actual expenditure or 5% of adjusted total income, whichever is less. This can only be the maximum expenditure that can be claimed. And what is adjusted total income? Total income before claiming the head office expenses or unabsorbed depreciations, etc. Okay, that can only be claimed. For a minute, I walk out and come back. Okay, actually, these definitions I have given in some other chapter. So, I'm taking you to page number 67 in your material. I'm taking you for printed material or for system material 68. This is the list of head office expenditure. Okay. Their administrative expenses like salaries, rent, traveling, establishment expenses, all these things which they incur in general for all these. Limitations we all know. Actual amount or 5% of ATI, whichever is less. What is ATI? Total income excluding So add back. If you have already reduced, you need to add back. Depreciation. So I can easily tell you earnings before depreciation. Earnings before depreciation and amortization. Okay. We call it as EBITDA. Okay. Capital expenditure on family planning. These are brought forward losses. Okay. Any other income other than business income, all these things. Okay, this is ATI. So you can rely on page number 67 where don't waste your time on this. This is easy to remember only. This is not very difficult to remember. Okay, it is before claiming depreciation, any losses, etc., you will take it as adjusted on that 5%. Actual expenses or 5% of adjust. So they don't want you to make loss because of head office expenditure. (44) DA. Section 44 DA, royalty and fees for technical services by a non-resident. Sir, I studied this in section 115A already. You are telling me that these are taxable at 10%? No expenses can be allowed? Again, the same heading is hitting. Which one should I apply? All of us, one-time understanding, and it is going to be perfectly clear till our examinations. 115 is applicable where there is no permanent establishment in India. Once more, okay? Section 115 versus 44 DA for royalty and fees for technical services. If the foreign company, okay, if the foreign company has PE in India, 44 DA. If the foreign company does not have PE in India, 115. That is the difference. Here it is simple, 10% and no expenses can be claimed. We all know this is simple. 10% is the rate of tax. You cannot claim any expenditure. This 44 DA. If the foreign company has a permanent establishment in India. If the foreign company has a permanent establishment in India, then 44 DA. What is the sanctity? It is coming under PGBP chapter. This is a separate chapter where directly the rates are given. This is a PGBP related chapter. Okay. So there is a reason for bringing it into PGBP, and it is not presumptive computation. And it is not presumptive computation. If the foreign company does not have PE, go to 150. If the foreign company has PE, come here. What is PE, sir? Any place, my dear friends. Small definitions, I have given it in a separate arena. So that includes a place of business through which the business of the enterprises is wholly or partially carried on. It can be a branch, it can be an agent's office, it is an address. Okay. P is a place of business. According to this section, the following expenses are allowed as deduction. The following expenses are allowed as deduction from royalty. So it is a computation. It is not presumptive. You should compute what is the profit under this. Expenses wholly and exclusively for earning such income in India. Expenses wholly and exclusively. Not only in this section, in very many sections, the law uses the word wholly, exclusively. We have seen even in the beginning of the residential status chapter, if the whole of the control and management is in India, if part of the control and management wholly, exclusively, wholly means quantum, exclusively means purpose. Wholly means quantum, the entire quantum of expenditure. Exclusive means purpose. The entire quantum of expenditure should be for the purpose of earning this royalty income. The whole quantum should be for the purpose of earning this royalty income. 70% of the expenses. No. The whole expenses are for earning Indian income wholly and exclusively for earning this. Apart from this, I will allow any reimbursements. Reimbursement means incurred wholly and exclusively for this, and I am giving it back. Somebody else. It can be head office or another branch of in the foreign company who has incurred the expenditure on behalf of the Indian entity, Indian PE, so I give it back. What is not allowed? What is not allowed? Allocation of cost. Expenses other than reimbursement paid to head office or any other office. Expenses other than reimbursement paid to HO or any other office. So, whether you will go by 44 DA or whether you will go by 115 depends on whether PE is there or not. PE not there, go to 115. PE there, come to 44 DA. Compute the income, taxable income. It is not a presumptive computation. I have not given you any percentage. There, I have given you percentage of tax, not even computation. Whatever income into 10% pay the tax, go. Here I am saying, boss, you are an Indian office. Follow the Indian law. Give me the computation like this. So, friends, there are 4 presumptive taxation. 2 of them are very important. Non-resident shipping business, aircraft business. The other 2, examination point of view, not very important. Civil construction and leasing out, 10% is there, but have it in the memory. There are 2 other provisions which are there. 44C, head office expenditure. Actual expenditure are 5% of ATI. ATI means all the take the net profit, add back the depreciation that is charged or losses which are being set off. You will get the ATI on that 5%. The last one is 44DA, the applicability being when there is a PE, the entire expenditure incurred for the purpose of earning that royalty and reimbursements will be allowed. Just there is an allocation of cost or expenses which is not of reimbursement nature will not be allowed. Please go through it once. I think we did up to 23rd question. Okay, I'm not saying that I'm totally going to 44D. There will be some questions also for both non-resident, everything. Question number 24. The following data is furnished by Mr. Sumed, a non-resident and a person of Indian origin for the financial year 21. Long-term capital gain on transfer of foreign exchange asset. Expenditure wholly and exclusively incurred on such transfer. Interest on deposit held with private limited companies. Interest on government securities. Interest on deposit with public limited companies. Dividend from domestic companies. Savings and investments. Investment in notified savings securities referred to in section 10(4)(b) on 3321. Investment in shares of Indian public limited companies 3 lakhs. Tax deducted at source 1,83,000. Ltcg on transfer of foreign exchange asset. He is a non-resident and person of Indian origin. Okay. Ltcg on transfer of foreign exchange asset 650. Cost of transfer 80 is allowed. Nowhere I said cost of transfer cannot be claimed. Indexation benefit is not there, accepted. They have said computed, which means they have taken care. And Expenses under 5728, all those things are not allowed, accepted. Cost of transfer, nowhere we said you cannot claim. Unfortunately, they have done the question without cost of transfer. Now we will do recomputing LTCG. LTCG on foreign exchange asset. LTCG on foreign exchange asset 6,50,000 less cost of transfer 80,000. He is a non-resident Indian. He is a non-resident Indian. Okay. If he reinvests within 6 months, okay, if he reinvests within 6 months, then exemption can be claimed. We all know if he reinvests within 6 months, the net consideration, exemption can be claimed. Unfortunately, he has only reinvested after 6 months. He has not invested within 6 months. The date is not wrong. I remember the exam question also, they gave it like this. He has not reinvested within 6 months. Since assessee has not reinvested within 6 months, whole of the CG becomes taxable. Okay, so in this case he has not reinvested within 6 months, so it becomes taxable. Other sources. The question has not specified that investment is made in foreign currency. Hence, applying the normal computation. The question should say loan has been given in foreign currency. Investment has been made in foreign currency to enjoy that 20%. But it is better in the case of individuals. I always tell you it is better to go by normal computation because you will go by slab rates. You will go by slab rates. We saw in that sportsperson question, if you remember, if he is a match referee, he is paying lesser tax, correct? If he is a match referee, he is paying lesser tax here. He is paying 39,000, whereas if he is a sports person, he is paying 1,30,000. Why? Because the special rates does not enjoy basic exemption limit, does not enjoy any other investments, etc. So, if he is your advice will be only be if he is an individual, if it is a company, because that's why the provisions are more for companies, foreign companies. Okay, for them, instead of paying 40%, 20% is a bigger advantage. So other sources, interest from private limited companies, from private limited companies, 5,90,000. From government securities, 95,000. From deposits in public limited companies, 2,60,000. Dividend taxable in the hands of a receiver from financial year 2021. Okay, so it is 75,000. Gross total income / total income. Ltcg taxable at 10%, 5,70,000. This is taxable at 10%. Balance income taxable at normal rates. So out of 15,90,000, 570 is taxable at 10%. This is taxable at normal rate. TDS credit is 1,83,000. So for a non-resident, because taxing it at 20% would have made him pay more tax only. This will be more beneficial. This will be more beneficial. That was May 19. This was November 19. Mr. Beast, a non-resident individual, earned interest income of 12 lakhs on an investment made in notified infrastructure debt fund set up in India eligible for exemption under 1047 during the financial year. Further, he incurred 15,000 as expenditure for earning such interest income. Examine the tax implication in the hands of both fund and beast and justify your conclusion with the relevant provision in two situations. If Mr. Beast is residing in a NJA and if Mr. Beast is stationed outside India in a place other than NJA, will there be a change in tax liability if Mr. Beast received fees for technical services from an Indian company in lieu of the interest income from infrastructure debt fund? Read it. On reading the question, you will always feel, if such a question comes, how I know only a part of it, or rather it is little confusing. Actually, it is not. If you highlight one word, that's all. The question comes and falls in front of you like anything. Okay? Infrastructure. I have already told you, infrastructure means 5%. All infrastructure except Ifsc, located in Ifsc 4%. Otherwise, all infrastructure, be it a company, be it a fund, be it a business trust, for the recipient, the tax rate is 5%. No expenses will be allowed. So actually, there is nothing in the question. But the way it has been framed, you will find it. And interestingly, we all know, if it is located in a NJA, rate as per Act 5%. Rates in force, whatever is there in DTAA, all 30%, whichever is higher. Are you understanding? It's actually a cakewalk question. Only thing is, we should say, oh, it's an infrastructure. Infrastructure means I know. And that confidence I know is going to make a lot of difference. I know with confidence, not I know with the hat over your head. I'm very sure you are all not like that. But I know it's infrastructure. That word, if you catch it, it's over. And sometimes we should not read the question like makes an investment in notified infrastructure set up in eligible for exemption under 1047. Oh, it's exempt. No, for the infrastructure fund it is exempt. Okay, you should not understand for the receiver agent. This notified infrastructure debt fund of section 1047, the income for the infrastructure fund is exempt, not for the receiver from that infrastructure funds. And the last part of the answer also we know. See, the examiner who is setting the paper want to give some 5 or 6 marks for this question. What else can he ask? So he is trying to use the same words in such a manner which we are all aware actually, which we are all, it's not. I told you, if you remember 115A, it's easy to remember. Shall I repeat 115A once? Dividend, interest, dividend from mutual fund. Investment should be in foreign exchange, 20%. Royalty, fees for technical service, 10%. Interest from all infrastructure aspects, be it a company, be it a business trust, be it government, be it notified entities, 5%. If it is from a unit located in Ifsc, 4%. That's an amendment. That's all. Question should not challenge your, question should not shake your understanding. That alone I want to ensure. They will not question you out of the blue something. And at the end of the classrooms, I will tell you, in our general practice itself is, if you are doing any activities, business, game, class, everything, first few minutes is for God. Okay, sorry for my Tamil phrase because it comes faster. Idu Swamikku. Like that, 10 marks, let them ask out of the question also. Out of 90, we know how to score 60. I'll come to that at the end of the classrooms. So please don't even think they will go out of the blue. Wait for the today's end of the class also. I will try to, if we are ending international taxation up to equity, equalization levy, I'll come. So coming back to this question, never get worried about the question. Let our understanding be superior. Let our wordings or the catchwords be superior. Question number 25. What is the question? Mr. B, with relevant to Mr. Okay, examine the tax implication in the hands of both the fund and the receiver. Let me, in the hand of fund, the income is exempt from taxation under 1047. However, fund is liable to deduct tax when it is distributed, when the income is given. On the interest income, tax is liable to be deducted at 5% plus HEC of 4%. For all non-residents, surcharge and HEC, if it is applicable, it will be added. Salaries also, it will be added. So it will be 5.2%. 5.2%. That is the TDS to be deducted. Where the receiver is located in NJA, notified jurisdictional area, then tax to be deducted is higher of the following. Rates as per Act, we all know it is 5.2%. Rates in force, that if it is a NJA, where is the question of DTAA? So no problem. 30%. So hence the fund is liable to deduct tax at 30%. Hence the fund is liable to deduct tax at 30% when, if it is located in NJA. If it is located in NJA, this is the provision. interest income is taxable and expenses cannot be claimed against such income. You cannot claim expenses. That is the only difference. Otherwise, the 5 point, I am going to repeat the same answer. The question has said, this gentleman has an expenditure of 15,000 cannot be claimed. Sometimes when rupee font is used, this point becomes inevitable. Okay, so don't understand it as 0.12 lakhs. It is 12 lakhs only. This point that is coming after the rupee font, I try to avoid, but sometimes it is inevitable, and in the interest of typing the question, we forget those things. So it is 12. So entire 12 lakhs, okay, the whole of rupees 12 lakhs of interest is taxable at 5.2%. Okay, so what will happen? 12 lakh into 5.2%, 62,400. Interestingly, where tax has been deducted at source, then Mr. Bist is not liable to file the returns. Where tax has been deducted, that's what the fund has to do. So Mr. Beast is not liable to file the return. Mr. Beast is not liable to file the return. The provisions are the same if Mr. Beast is located in NJA, with the difference that the rate of tax will be 30% plus 4%. With the difference 30% plus 4%, 31.2%. So what happens? The tax will be 12 lakhs. Again, expenses cannot be claimed. Again, if tax has been deducted at source, which the fund has to do, you need not file your return. But the provisions are same. The only difference is the amount. You can see the amount varies very greatly. Will there be any change in the tax liability of Mr. Best if the income received, that is this 12 lakhs, this is the income received, is fee for technical services from an Indian company instead of interest? Okay, where the income received is fee for technical services. Okay, according to section 115A, FTS will be taxable at 10%. The concessional rate is available only for interest. That 5% rate is only for interest. In fact, not even dividend, only for interest. So FTS is taxable at 10%. Expenses cannot be claimed. So what happens? This 12 lakhs would have been taxable at 10%. I'll make it 10.4. Okay. So had it been only, okay, we saw in that red delimited question, the last question we worked yesterday, remember that question, okay, that instead of paying the charges, I allotted debentures, okay, same way. If they give it in the form of FTS, this will be the answer. Okay. Question number 26. A foreign company carries on business through a branch located in India. PE is in India. PE is in India. So the basis of computation is section 44DA. So the basis of computation is section 44DA. What are all the key aspects of 44DA? Expenses wholly and exclusively for the purpose of earning that income will be allowed, other than that only reimbursement. No question of any allocation, no question of any other expenses other than reimbursements which are paid outside. Tax implication, the hands of the fund, I told you, Abhiprita, that it is exempt. 1047 is the exemption applicable for them. So for them, the income, the tax implication here is the TDS which they are liable to deduct. Royalty received in pursuance of an agreement, 200 lakhs. Royalty received is 200 lakhs. Depreciation as per income tax on assets in India, you can claim. Depreciation as per income tax on assets located in India, which are partially, you don't even read. You cannot claim wholly and exclusively. Salary and other expenses for India. Payment to Singapore office for use of their data. Unless the data is exclusively for India, you cannot claim it. Don't make that assumption also. You cannot claim it. Reimbursement of actual expenses allowed. Paid to head office for apportionment of expenses not allowed. Interest received on money lent in foreign currency, commission. Read through. I'm very hungry. I came out in the morning. Allow me. Because you have PE in India, 44DA is only applicable and not 115A. Less allowable expenses. Once more, I am recollecting for our class purposes. Expenses wholly and exclusively incurred will be allowed. reimbursement will be allowed. Other than that, nothing will be allowed. Depreciation on Indian assets, 10 lakhs. Depreciation on assets outside India, which is partially used for Indian operation, not allowed, as it is not wholly and exclusively for earning such income.
Not audible.
Voice is not clear. Can you please text me if you have a doubt? You can even. Investment is in foreign currency, so you cannot claim anything. Commission income 90 lakhs, less expenses because it is taxable at normal rates. There is no special rates. Remember, the total income exceeds 1 crore and it is a foreign company, Converges Limited. Okay? A foreign company. So the rate of taxation will be 40% for this, except interest, which is taxable at 20. I'll work out, but generally I'm saying. That's why I work the total income also to tell you that it exceeds 1 crore. So if it is having a PE 44 DA computation where expenses incurred wholly and exclusively will be allowed. This might be the only confusion. Why can't I assume it to be wholly and unless the data is there, probably I am not earning that royalty. You can do an alternative assumption if you want. You can do, okay? Or in exam, you'll have a quick time from 58 lakhs, you reduce that and show it also. But generally, unless they are specifically giving, you don't take it, is our opinion. Question number 27. X, while making payment to a non-resident for providing technical service on a World Bank aided project, net of tax, has deducted tax at rates prescribed, but he says that the receiver is not entitled to TDS certificate since the tax was not to be borne by the receiver as per the axiom. Examples. We in our normal practical aspect also you would have found this case. I am liable to pay 5 lakhs to a person. What happens in technical way is 5 lakh minus, let us take 10%. I should pay in 4 lakh 50 and pay 50,000. But unfortunately, the agreement has been entered. I will pay you 5 lakhs. So 5 lakhs becomes the net. I need to gross up. So if 5 lakhs is 90%, what is 10%? And I pay the tax. Let us, for example, take it that it came to 5,55,000 and I paid 55,000. I paid in 5 lakhs. Now he is demanding, especially if it is a non-resident, they will demand, vice versa also. In that country happens, we the residents demand. Give me the tax certificate so that in my country I can claim DTAA benefit. And I say, no, you are not eligible for any tax credit facility because you have not borne the tax. I have only borne the tax. So the question is, should I give TDS certificate? The answer is yes. Now the income of the non-resident is not 5 lakh, it is 5,55,000. Even if it is a resident assessee, the same principle. If you have grossed up and paid, then the gross amount will be the income, and this 5 lakh in the given example is the net amount. Income is always gross. So there is nothing called you have borne the TDS. The income of that non-resident will be accordingly increased. Where tax is grossed up and paid. Is the receiver liable to receive TDS certificate? That is the question that we have. Yes. The grossed up amount shall be considered as income in the hands of the receiver and not the received amount. Okay, the grossed up amount will be considered as income. The grossed up amount will be considered as income in the hands of the receiver and not the received amount. Tax certificate will enable him to claim benefits of DTAA and foreign tax credit. So you need to provide the certificate. You don't have an option. You all know how it appears in 26 AS. Similarly, in DTAA also, the other party should be available, should be appreciated or should be knowing this. That's why. Okay, right? Fine. Sorry for not questioning numbering it. I'll do it in the Excel sheet. Question number 28. The net result of the business carried on by a branch of a foreign company in India for the year ended was a loss of 100 lakhs after charging head office expenditure of 200 lakhs allocated to the branch. Explain with reason the income to be declared by the branch. The question itself is head office expenditure. The question itself is head office expenditure. The maximum HO expenses that is allowed under 44C is actual expenses or 5% of adjusted total income, whichever is less. The maximum allowed is this. Net profit as per profit and loss count. They say that there is a loss of 100 lakhs. And HO expenses that has been charged, because this is after charging head office expenses of 200 lakhs. Depreciation and all they have not given. If they have given depreciation, you should add up that also. Once more, if they have given depreciation, we should add up that also. Okay, so this becomes adjusted total income. This becomes adjusted total income. Okay, less maximum HO expenses. Actual expenses we all know is 2 crores. 5% of adjusted total income is only 5 lakhs. Okay, whichever is less is only allowed. Whichever is less is only allowed. Okay, taxable income. Okay, because as I told you, because of head office expenses, don't try to claim loss and all. It is not possible. Question number 29. ABN Limited is incorporated in Australia and it carries on banking business. It has branches in different countries including India. During the financial year 2021, the Indian branch of the bank paid interest of 25 lakhs and 10 lakhs to its head office in Australia and the branch office in London. Explain with reason whether interest so paid shall be taxable. Obviously, yes. Interest accrues or arises from India. Interest accrues or arises from India for the receiver. The receiver is a head office in outside India, London branch. So both are non-residents. Any income according to section 9, any income accruing or arising from India is taxable in the hands of non-resident. Interest paid by a resident assessee or by government of India or by another non-resident on money lent for business purpose in India is taxable for the receiving owner. In the instant case, what happens? ABN Bank Limited, and it carries on bank. Okay, the Indian branch of a foreign bank is paying interest to non-resident, that is HO, and another foreign bank. Okay, the Indian branch of a foreign bank is paying, and the receiver is a non-resident. It can be head office or the London branch office. For the receiver, such income accrues or arises from India, hence it is taxable. If the confusion in question number, I will, this is 13. Okay. Mr. Q, a non-resident, operates an aircraft between Singapore and Chennai. He received the following amounts while carrying on the business of operation of aircraft for the year ended. 2 crores in India on account of carriage of passengers from Chennai. 1 crore in India on account of carriage of goods from Chennai. 3 crores in India on account of carriage of passengers from Singapore. 1 crore in Singapore on account of carriage of passengers from Chennai. The total expenditure incurred by Mr. Q for the purpose of business during the year is 6.75. Compute the income of Mr. Q chargeable to India under PGBP for the assessment year. Would your answer in case of the business, in case the business was carried on by a foreign company, would your answer change if it is a foreign company instead of an individual? Read through. Good time to tell you something that which I missed it out in while doing the presumptive taxation. I told you there are presumptive taxation under 44 AD, ADA, AE, that is for Indian assessees. 44B, BB, all these things are for non-resident assessees. The one big difference is, for the Indian assessee, there is a limitation up to 2 crores in the case of 44 AD, up to 50 lakhs in the case of 44 ADA, up to 10 vehicles and 2 crores in the case of 44 AE. Such restrictions are not there for non-residents. Their presumptive income is irrespective of the level of turnover. Their presumptive income, whatever I am specifying here as 5%, 10%, etc., is irrespective of their turnover. Turnover can even be 500 crores. Audit mandatory, yeah, nothing, sir. You pay 5%. I mean, you declare 5% as income. Nothing else is mandatory. Okay, so that turnover limitation is not there. Okay, so here now coming to this question, actually the question number should be 30. Airline business. Some base provisions before going into the main aspect. According to section 44BA, 5% of the gross receipts shall be treated as income. So there is nothing called expenditure. That 6.75 crores which they have set as expenditure, ignore it. In our presumptive computation for a resident assessee, what we will do, 8% or 6% as the case may be, or actual income. If the actual income is lesser, then audit is mandatory. We will compare. Here there is no option, sir. You are declaring 5% as income. So there is no option even to claim that expenditure of 6.75 crores. That is just given to confuse you. 5% of gross receipts will be treated as income. It is not optional provision. It is shall. It is mandatory that you follow this. This leads me to a question which we started the entire non-resident chapter with. What is income? For a non-resident, what is income in India? Received in India is an income. Accruing or arising from India is an income. Wherever it is, if it is received in India, it is an income. Accruing or arising from India, if the journey commences from India, then it means it is accruing or arising from India. You or me is traveling through a Singapore Airlines, France Airlines, Lufthansa, British Airways, American Airways from Chennai. The air ticket probably is bought by our friend in US. He paid there and bought the air ticket. But is it taxable in India? Yes. A resident assessee is traveling. The commencement point of the journey is India. Vice versa. Some US person is coming from US to Chennai. But if the tickets are booked in Chennai, it becomes taxable because income is received in India. Income is received in India. So for a non-resident, we are all very clear. Received in India, accruing or arising from India is taxable. Let's go ahead. 2 crores on account of carriage of passengers from Chennai. Carrying of passengers from Chennai accrues or arises from India. So taxable here, I will take the whole amount and then compute the income. Of the whole amount, I will compute the income. This is a receipt. 1 crore on account of carriage of goods from Chennai. Same principle. 3 crores in India on account of carriage of passengers from Singapore. Unfortunately, you should have booked the ticket in Singapore. You have booked it in India. It is taxable in India. One crore in Singapore on account of carriage of passengers from Chennai. The answer will not change if it is a company. Provisions are for all non-residents. However, tax computation will change. For individual, we go by the slab rates. For the company, there is no tax rate given. It is not coming under 115. It is a computation methodology under 44BA. So for company, it will be 40%. For us, for individual, it will be the slab rate. That is the difference and not the mode of computation. Give me 1 minute. Just stay back. Just stay back. I'm searching for something. Just stay back. Stay back, please. My dear friends, I typed a question, but unfortunately I missed it out in including it. This is our study material question. I want to do this because I'm vaguely of the belief that FII can also be a question. Okay, this is our study material question, my dear friends. Our study material, which is which might be with you, or it is available in the net also, or I will paste it the question and send it to you. Okay, style in, I hope the screen is visible. Okay, style incorporation, a notified FII. Style incorporation, a notified FII derived following incomes. So it is a foreign institutional investor, FII. Okay, if I go back to our material, okay, I told you what is the importance of FII. Okay, this is 115 AD rates. Dividend, interest, Ltcg, up to 1 lakh you can claim, the balance taxable at 10%. Interest income on infrastructure investment. We all know if it is infrastructure, STCG 30%. Okay, category 3 alternative fund 10%. Surcharge up to 50 lakhs, I mean up to 1 crore it is not there. Beyond 1 crore, it is the same, but the question which I am reading is not about surcharge, it is about understanding of the income computation. Style incorporation, a FII, derived the following incomes for the financial year. Interest received on RDB, dividend from listed shares of Indian company, interest on securities, income from sale of securities, bonds of J, this is bonds, not equity shares, it is bonds. Sale proceeds, cost. Okay, and purposefully they will give you the indexation also, please remember. Equity shares, listed shares, sales consideration, STT paid. Unlisted shares. Okay, date of purchase 1st July 2020, sale 7th March 21. Date of purchase, so it is a STCG. It is an STCG. Since I have not posted the question, I will show you the answer directly, but it's simple only. That is, all these interest incomes are taxable. Okay, RDB is taxable, dividend income is taxable, interest no deduction. Ltcg, we all know for bonds, debentures, no question of indexation, even though it is a long-term capital gain. Even though it is a long-term capital gain, again in capital gains chapter, I will repeat, bonds and debentures does not have the benefit of indexation. STCG, this will be taxable at 30%. This will be taxable at 30%. Okay, and other STCG. Yeah, here is the tax working. 5% rupee denominated bonds. Otherwise, dividend and interest 20%. RDB is 5%. Dividend and unit interest 20%. Ltcg 10%. Okay. STCG on which STT is paid 15%. Other STCG 30%. Okay. The income has not exceeded 1 crore in this question. Otherwise, they would have done the surcharge also. Okay, otherwise they would have done the surcharge also. I will incorporate it in our Excel sheet and send it to you also in our same pattern in which we will work. Okay, but this question, in my opinion, slightly important because FII is 115 AD is also an important question nowadays. It is there in our study material. You are very much clear with the rates. Only thing is how to apply it and do it. Okay, so you know expenses cannot be claimed. You should mark that STCG. STCG on which STT paid. Ltcg on which STT paid. Other STCG. Like that, if you are able to differentiate, the answer is very clear. So this is one of the questions. I typed this question. Unfortunately, at the last minute, I couldn't incorporate it in the material. I will try to put it in our Excel sheet and send it to you so that you are clear about the question, and I will answer it in our own style in which we will answer so that more clarity is there. Remember, FII can also be a questionable area. Okay, okay. So, so with regard to non-resident taxation, in our coverage of syllabus, we have cleared the practical coverages to a larger extent we have done. That is, we now know residential status, scope of total income, computation of income in special cases, computation in the case of presumptive, and to an extent we also know what is exempt income. Whatever is the rates here are the tax rates also. Whatever is the rates here are almost the tax rates also. Salary for a non-resident is in the average rate. Winnings 30%. Sports persons entertaining sports association. Remember the BCCI case law. Commission is in the same rate. Infrastructure debt fund, just now we saw a question also. All these infrastructure are 5%. Okay. Regarding business trust tax provision 194 LBA LBC, I will come to business trust also. Suppose if you have seen the amendment lecture, you will understand this. It depends upon whether the dividend distributing SPV is taxable at normal rates, or they have gone for optional rates. If they are taxable at normal rates, it is not taxable for the recipient at all levels. If they are opting for optional tax regime, so if you have seen the amendment lectures, you will be able to collect it. If you are unable to see the amendment lecture due to lack of time or other thing, while doing that business trust, I will again tell you, but I would still insist that you see amendment lectures. Okay. Infrastructure bonds, and this 4% is for Ifsc. RDB 194N is the same. Okay, so all these rates are not something which is new to us. We have been applying these rates only and computing. The rates will match because if you deduct tax, that entity is not liable to file the return even, so the rates will match. So the rates will match. The last part of the discussion on non-resident taxation, which I promised to you, is to consolidate the provisions of Ifsc. Okay, it has not been so far questioned directly, but I want you to be aware of it. Anytime when they are questioning, we are hitting it at. Okay, this is just consolidation of the provision of Ifsc, which is found scattered in various places in the law, which I am trying to consolidate. What is Ifsc? International Financial Service Center. Now it is in Gujarat. It is known as Gift City. It is known as Gift City, Gujarat International Financial Tech Park or something like that. Okay, it is okay. So it is like a special economic zone. Only non-residents are allowed to transact. Intention is very clear, bringing foreign currency. Intention is retain that foreign currency also. So give them some exemptions. Why should a non-resident investee should prefer India as their destination unless tax concessions and incentives are there? Unless compliance procedures are simple, nobody will come and invest. Dr. Manmohan Singh, to my knowledge, the greatest person we have ever seen in finance ministry, has always said this. It is his vision to say, make the procedure simple. That's why you see, if tax is deducted at source, you need not file your return. So if return is not filed, no assessment, nothing. But at the same time, India is ensuring that tax is collected. Okay, so map the rate in such a manner that the rates of taxation and the rates of TDS is the same, so that is fulfilled. Second, make the rates lower for them, 5%, 10%, because internationally, that is, then only we will have a competitive advantage with Philippines, Singapore, Europe, many destination available. Why should a non-resident, I'm not talking about NRI, leave alone the emotional connect that I might have. I am talking about a foreign company or non-resident. Why should they prefer? So make it a good destination for investment by giving lot of tax incentives. So Ifsc is a specific special economic zone like aspect for a foreign company non-resident investors. Okay. Basically, center located in SEZ, which cater to customer outside the base territory, dealing with fund flow, financial product and services. It's in gift. Non-resident can buy, actually I should not write including, for non-resident means non-resident individuals, non-resident foreign company, everything. Can buy and sell securities which will include equity, debt, derivative, in foreign exchange, in stock exchanges located at Ifsc. In capital gain, I am providing them lot of concession. You You will be surprised there is no STT, CTT for them. There is no STT, CTT for them. No security transaction tax, commodity transaction tax, but the methodology of computation is the same. Just because STT is not paid, am I going to be taxable at them at 20%? Sir, 112A or 111A is only applicable where STT is paid. So, since there is no STT, am I going to tax them at 30% or 20%? The answer is no. They enjoy the concessional rate, even though they are not paying. That is the benefits which I gave. Section 47, transactions not regarded as transfer, not considered, no capital gains, applicable for global depository, rupee denominated bonds, derivative, other securities. Only condition is sell it also to a non-resident and ensure the consideration is received in foreign exchange. A non-resident in Ifsc cannot sell it to a resident assessee here and try to get this benefit. The purpose is, I want foreign exchange. So, sell it to another non-resident and receive the consideration in foreign exchange. The provisions specify any transfer of the above asset made by a non-resident on a recognized stock exchange in Ifsc, the consideration of which is paid or payable in FE, foreign exchange, is not considered as transfer. So, you are a non-resident, sell it to another non-resident, bring the consideration to India in foreign exchange, convertible foreign exchange. Thus, you are not liable to capital. It is not a transfer at all, no capital gain arises. Once more, a non-resident who is having GDRs, RDB, derivatives or other securities listed in a recognized stock exchange located in Ifsc, if he sells his security to another non-resident and the consideration is received in convertible foreign exchange, the transaction will not be treated as transfer and no capital gain arises. No capital gain arises. They are exempt from security transaction tax. At the same time, they will enjoy the exemption under exempt. Sir, what is this exemption? Up to 1 lakh, it is not taxable. More than 1 lakh, 112A is applicable. Up to 1 lakh, it is not taxable. No. Sir, STT is not paying. Still, they can enjoy the exemption. This exemption can be availed even if STT is not paid. Similarly, 111A can be availed 115% on Ltcg. Even if STT is not paid. For the MAT rate is 9%. For all other entities, including any other foreign company, 15%. But if it is a foreign company located in Ifsc, the rate is only 9%. AMT is also 9% instead of 18.9 for non-corporate assessees, for LLPs, etc. Another big benefit for them is this deduction under section 80 LA. When we are going to read 115 JB and optional tax regime format, okay, optional tax regime format, deductions under chapter 115B AA, 115B AB, deductions under section under chapter 6A cannot be claimed except 80 JJ, AA and 80 M and also 80 LA. Though it is not for a resident assessee, not even for a foreign company which is outside the territory of GIFT. Income of units located in Ifsc is allowed deduction of 100% of the profits for 10 years out of the first 15 years of operation. They can claim. And then comes the major this has amendments. I didn't mark it in blue, but remember 10.4D is the major amendment that came into. This provision is applicable for a specified fund. That leads us, what is a specified fund? Specified fund is a fund established or incorporated in India in the form of a trust or company or LLP or body corporate, okay, which is falling under category 3 of alternative investment fund, SEBI guidelines, which is falling under category 3 of alternative investment fund, and it is located in Ifsc, and almost every shareholder is a non-resident. Okay, specified fund is a fund established or incorporated in India in the form of a trust, company, LLP or any other thing, which is registered under alternative category 3 of alternative investment fund, SEBI guidelines. It is located in Ifsc. All the units are held by non-residents, of course. If there are some fund manager sponsors or managers, fine. What is exempt for a specified fund or the unit holder of a specified fund? Following income accruing or arising or received by a specified fund is exempt to the extent such income is attributable to the non-resident, not being if they have a permanent establishment in India, it is not. Okay. Capital gains arising from transfer of bonds, public sector company, of an Indian company or PSC, GDR, RDB, derivatives or any other notified securities, provided the consideration is received. This we have already seen, but here also they have said. Any income, so not only capital gain, any income, which means dividend or interest. Capital gain we already know, but apart from it, any income from transfer of securities or any income from securities issued by a non-resident, and where such income otherwise does not accrue or arise in India, any income from securitization trust which is chargeable, we will see that. And the same is also exempt for the unit holder. Income accruing or arising by a unit holder from a specified fund. So not only for the fund, but also for the unit holder who is a non-resident. These are all some of the things which are for Ifsc. So far, it is not questioned. Once go through, especially 10.4D, once remember, if at all there is a theory question, we know how to answer that. But remember the math-based exemptions which are given 9%, and also remember 111A, STT, CTT not applicable also, it is 15%. Otherwise, nothing very big except that practically this is a big exemption given for non-residents. One read through before your examination. I'll tell you how to spend time also later. This is the last part, which is a supplementary part for whatever we have read. Actually, this should have been the first part also sometimes. What is fee for technical services? Any consideration, it can even be lump sum consideration for managerial, technical or consultancy services, but not for assembly, mining, these are okay, where it is chargeable under salaries. Royalty. What is a royalty? It can be again any consideration one time also or on parts for transfer of all rights in respect of patent, invention, model, design, secret formula or any trademarks, etc. Imparting of any knowledge. The payment received, you call it training expenses, but I name it everything for royalty concerning the use of whatever I said in the one. Giving usage benefit. More for software this will be. Right to use any industrial, commercial or scientific equipment. We saw in a question also Jupiter, Madan and Co. These are also right. And along with an amendment, the transfer of all or any right, including granting of license in respect of any copyright, literary, this is for other than technical and other, okay, giving copyright, literary right, artistic or scientific work, including films or videotapes in connection. And this is the amendment. So far it was not included. Now it is included. A similar amendment was made in 194J. For a resident assessee also, the rate of taxation becomes 2% for that, okay, including consideration for sale, distribution or exhibition of films. Because of Amazon, Netflix and all, they have now brought that even that transfer will be treated as royalty. Let there be a taxation on that. We complete our non-resident part of our discussion. Okay. In terms of importance, it comes next to transfer pricing. In terms of questions, two things. Please be sure about poem. Please be clear about the rates. Please remember the two things, 2 or 3 sections which I highlighted. Otherwise, accrual arising and all, I am very sure you will now able to answer it with ease. Okay, section 9 and all, you will sweep it. I am very confident about it. Ifsc and how to prepare before that 2 days gap, 1.5 days gap for examination. I will tell you. that. Moving on to an area which is very friendly, very simple, at the same time sure short questionable areas. Okay, and one among the sure short questionable area is DTAA, Double Taxation Avoidance Agreements. DTAA, Double Taxation Avoidance Agreement. Why this chapter? We all know the reason for this chapter. This chapter is because country of source and country of residence both might tax and income. Country of source. So far we have worked out so many non-resident questions. Mr. Beast. It will be taxable in that country also. Singapore Airlines, it will be taxable in Singapore also. Royalty received by a German company, it will be taxable in Germany also. Colombo person who gave technical services in India, it will be taxable in Colombo also. And the vice versa can also happen. So, countries started entering into agreements. Countries started entering into agreements. What agreement? Double taxation avoidance. One of the country will only tax and the other country has to provide exemption or relief. I am very clear and choosing the wordings. The other country has to give either exemption. Exemption means totally don't tax that income. Let the other country itself tax. Or relief. Tax it, but whatever tax he has paid in the other country, please give him as a deduction. So, countries started entering into DTAA. DTAA is also about exchange of information. DTAA is also about how the tax revenue will be shared. DTAA is also about where there is a default, how to which country will have what is the so many things. One of the part is taxation. Just because India has not entered into an agreement with a country, as a resident can I suffer? Countries not entering into agreement is not in my hands. They don't have an agreement. Does that mean I have to twice pay the tax? No, the law gives you a relief. In that case also, the relief is available. So, basically, three sections are covered in this: 90, 90A and 91. 90, where there is agreement, bilateral relief. Bilateral means both the parties, because the agreement is there. 90A is a specific provision for some specified associations. Leave it. 91, unilateral relief. Agreement not there does not mean a resident, my resident assessee should suffer. Let the relief be not given by both the parties. For my residents, I need to give unilateral relief. The concept of avoidance is either bilateral, where agreement exists between both the countries, or unilateral, refers to where agreement does not exist. In the absence of the agreement, it becomes the duty of the country in which the assessee is a resident to offer the benefit. In other words, non-existence of agreement is not the fault of the assessee. So he should get the benefit. He should get the benefit. First, a quick look at what is bilateral. Bilateral means where there is India and Germany, India and US. Royalty earned will only be taxable in US and not India. We call it as exemption method. In India, that income is exempt. Royalty earned by a resident assessee from a US company in US will only be taxed in US, will not be taxed in India. If this is the provision of the agreement, that means in India, you need not declare it as income. It is like Section 10 exemption. In India, you need not declare it as income at all. Income exempt method. The income earned is exempt in India. The other is tax credit method. It is taxed in India, but whatever tax you paid in US, you can claim it as deduction. Once more, repeat. Whatever tax you have paid it in US, you can claim it as deduction. The same is going to be said in unilateral also. Whatever tax, there you are going to use average tax and all, but still, please understand. Whatever tax you have paid outside India, you are going to enjoy some relief in India. Whatever tax we have paid outside India, we are going to enjoy some relief in India. This is what popularly known as foreign tax credit. Jargons. You called it, if it is in India, we call it as TDS. What is the TDS available? It's slightly local. Make it international. What's the foreign tax credit available? That's all is the difference. What is foreign tax credit? Tax paid outside India, but the income is considered in India. It is known as foreign tax credit. Whatever tax paid outside India. Outside India, I am paying GST. Outside India, I am paying various other taxes. Till the last year, they used the word whatever tax paid. So people were claiming that also, sir, I paid that also, sir. You can see, I have the proof. From this year, the law is whatever income tax paid in the other country. Income tax will always include surcharge and HEC, but it will not include interest and penalty, because that you are paying for violation. That is not tax. That is more of a fine, fee. But surcharge and HEC, I will include. Okay? So I know I'm talking a lot, but I'll definitely make you understand. If you pay some foreign taxes, which is similar to income tax, you claim it here. From financial year 21-22, that is after you becoming a chartered accountant, you will read that. It is part of the definition itself. Let's go slow. Bilateral. What did they say bilateral? Where both the parties have a central government may enter into an agreement with the government of any country outside India or specified territory. Okay, you often see two prime ministers signing, two finance ministers signing. Income on which income tax has been paid in India and in the other country or for granting relief, income tax chargeable under this act and under the corresponding law in force of that country. From this year, in our BEPS, we will talk more about it. Internationally, countries are not worried about double taxation. They are worried about double non-taxation. What if a person is going to escape taxation from both the countries? Provisions are made nowadays in our law. You can see. If you are an Indian citizen and your total income other than the foreign income is exceeding 15 lakhs and you are not taxable in other countries, due to your residential status or citizenship in other countries, then I will tax it. So, people are trying to escape. This is within the four walls of law only. They are not. I am trying to travel and try to escape. This is from the Indian perspective. If you see, it looks very small. If you see from the European perspective, it will become big. Because Europe has many countries which are like our railway stations. Guindy, St. Thomas Mount, Tambaram, Krompet, like that it goes. Belgium, Netherlands, France. For them, that's why OECD is basically looking at from Europe side of the whole world. If I am able to solve it here, it will be globally solved. So they are more worried about not just double taxation relief. That is for you. From the country's perspective, what they are worried about is, what if both the countries fail to tax? Double non-taxation should not be there. For avoidance of double taxation of income without creating opportunities for non-taxation or reduced taxation. That is now, I have written it in blue because it is an amendment in our law. I accept. The holistic purpose is to give you a relief. By giving you a relief, I am not ready to lose. Without creating an opportunity for non-taxation or reduced taxation through evasion, avoidance, or treaty shopping. I will operate from a country, royalties are not taxable in US. Interest is not taxable in Dubai. One other income not taxable in Ireland. So I create a company in US only gets royalty. A company in Dubai only finances and get interest. A company in Ireland is only producing and selling. What am I doing? Treaty shopping. Okay? Without creating opportunities for non-taxation or reduced taxation through tax evasion or avoidance of treating arrangements aimed at obtaining reliefs provided in the said agreement for the benefit of resident of any other. Originally, it is for providing benefit for the resident of our country, but somebody else is trying to get the benefit. Look at the words. For avoidance of double taxation. That is the intention of DTAA, without creating an opportunity to pay lesser tax or non-tax. How? By tax evasion or tax avoidance or treaty shopping. Treaty shopping arrangements aimed at obtaining relief provided. The purpose of that provision is to provide relief for the resident of that country. But you are not a resident of that country. You are trying to use that provision. Oh, in this country, if I start a company like this, company will become a resident. That company can get this benefit. Lifting or piercing of corporate veil will happen. Okay, right? Exchange of information, as I told you, is very important part of DTAA. Recovery of income tax, as I told you, is very important. So this is the purpose of DTAA. If there is a theory question, write it along with the amendment. Our paper will be our standing tone. Generally, there are two modes of giving relief. Exemption method. Income earned in the other country is not taxable in our country. Tax credit method. Whatever tax paid in the other country, I will provide it as a deduction, relief. 91, unilateral relief. Section 91 is unilateral relief. Resident Indian, income accruing or housing outside, and it does not have a DTAA. Relief is average tax on the doubly taxed income. Average tax as a percentage tax. I'll work out and show you, that will be easy. And 90A is for specified associations. Okay, it's only for specified associations which is entering into another specified, BCCI with ACB, CII with the configuration of Indian industries with something. Okay, this is very specific to that association. Don't worry about it. Important things to understand. Or this page is also as important. ground rules for DTAA, double taxation, tax residency certificate. Till 3 years back, we are all under super threat. As a practicing chartered accountant, we all faced a problem called the non-resident should also have PAN. That was removed. Now, if they give a TRC, that is enough. What is TRC? What is its importance? A person can be resident in more than one country. You all agree with me? Yes. In fact, 3 countries he can be at the same year. One country ROR, other 2 countries he can also be an RNOR. In which country he is going to declare the income which he is earning from India? Because he is trying to treaty shop there. And I'm not knowing to whom to supply this information. So now it is mandatory to give a tax residency certificate. So that to that country I will give the information about what income you earned from India. So the Indian deductor of tax, withholding of tax, TDS, royalty, we saw various cases, 5%, 4%, etc. They should get the TRC from that person. No more PAN, get the TRC. Okay? Then only I can properly deduct it. From the assessee's perspective, I give a benefit. Either DTAA or income tax law, whichever is beneficial to you, you take it. Okay? And whenever a resident assessee wants to claim some benefit, he has to give foreign tax credit. In our APA, I told you the last question, you will read it somewhere else. What is foreign tax certificate or foreign tax credit? Proof of tax paid outside India. I don't have a 26 AS here. So proof of tax paid outside India, and it is only for tax, surcharge and cess. It is not for interest and penalty. When I say tax, now it means only income tax. FTC will be applied provided in the year in which income is offered to tax in India. Same, resident assessee also same rule. Sir, interest I am accounting on cash basis, but my deductor does it on accrual basis. I cannot claim tax credit in the year in which I am declaring the interest only I can. Okay. Similarly, income declare, tax credit take. The Indian law permits income to be offered in various years. You can split. Then foreign tax credit also should be proportionately. FTC will not be allowed if you have gone on an appeal there. Foreign tax credit will not be allowed if you have disputed paying tax there. I will again recollect it when you are going to read assessment procedure, especially in appeals chapter section 248. When we are reading, I will again repeat this point from a different perspective and tell you FTC will not be allowed if tax paid outside India is disputed. However, you went on an appeal in that country, you lost the appeal in that year claim. However, later in the year in which judgment is provided and the judgment is against the assessee, FTC will be claimed in that year for the relevant previous year when income is. Read. FTC is an important theory question. our understanding now is going to be how to give this relief. What are all the aspects we should remember in giving the relief? An opportunity to recollect, actually not recollect, to work assessment of individuals also. Whatever you are unable to understand, leave it to me. When we do the assessment of individual, you will be able to understand it. Now, to a little extent, wherever possible, you can recollect it somewhere stored in your mind. Nandita, an individual resident, retired employee of Prachar Bharati, aged 60 years, senior citizen, is a well-known dramatist, deriving income of 1,10,000 from her theatrical works played abroad. Tax of 11,000 was deducted in the country where the plays were performed. India does not have DTAA with that country. Her income in India amounted to 510. In view of tax planning, she deposited 150 in PPF and contributed to pension fund 32,000. She also contributed 28,000 for medical insurance of herself and 26,000 for her father, a non-resident aged 84 years, who is not dependent on her. Compute the tax liability of Nandita. I will try to recollect a lot of things. Slowly we will, no problem. For the purpose of making the question really relevant, for the purpose of making the question really relevant, I wish a small change is made to the income here. A small change is made to the income because up to 5 lakhs, the entire tax is not going to be there. You can claim the relief rebate. So I am making it as 8,10,000. Just for making the question little relevant, I'm taking it as 8,10,000 and working. Okay, okay, okay. Computation of total income. Income earned from business profession in India. I'm just taking it as 8,10,000. Income earned from outside India, 1,10,000. Gross total income, 9,20,000. Gross total income, this 810 plus 110, 9,20,000. Just the recollection, if you don't remember, not issue, we will have it as a separate area of study. Deduction under chapter 6A. Deduction under chapter 6A. Section 80C. He has deposited 150 in PPF and paid contribution to approved pension fund 32. PPF deposit 1,50,000. LIC pension fund 32,000. 32,000. Okay. So she is getting a qualifying amount of 182. The maximum she can get is only 1,50,000. The maximum she can get is only 1,50,000. she cannot earn, she cannot get more than that in 80C part 1. So she cannot, okay. Section 80B. Okay, this is nothing but medical insurance, which includes central government health insurance scheme, everything. Okay, on her own health, on her own health, she has contributed 28,000 to CGGS and gave a medical insurance. Okay, oh, both are for father. Sorry, there is nothing called on her own health. On her father's health, parents need not be dependent. Parents need not be dependent. CGHS, Central Government Health Scheme contribution is 28,000. Insurance premium is 26,000. The total comes to, all of us, I want you to understand, 54,000. Normally, if the insured is a senior citizen, I can claim up to 50,000, but that is only for resident senior citizens. That is only for resident senior citizen. In this case, her father is a non-resident. Okay? Since her father is a non-resident, the extra benefit of rupees 25,000 is not available even though he is a senior citizen. So you can only claim 25,000. Additional 25,000 cannot be claimed because that is only for resident senior citizens. If one of the person who is insured is a resident senior citizen, instead of 25,000, 50,000. Total income. Total income 7,45,000. Total income is 7,45,000. Computation of tax. As a C is a senior citizen. So let's remember that. Up to rupees 2,50,000 nil. Next rupees 2,50,000 at 5 sorry, up to rupees 3 lakh. Just now I wrote. Next rupees 2 lakh at 5%. Balance 2,45,000 at 20%. That is 745 minus 5 lakhs. So into 20%. HEC at 4%. sorry, sorry, total tax before relief. Total tax before relief is 61,360 less relief under section 91 where DTAA does not exist. Relief under section 91 because with the other country I don't have double taxation avoidance agreement. Relief under section 91 because with the other country I don't have double taxation avoidance agreement. Please give me, please listen once, then we will take it down. Percentage of tax in the other country. In the other country, I have paid 11,000 for 1,10,000. 11,000 divided by 1,10,000 as a percentage, 10%. Percentage of tax in the other country, 10%. Average tax percentage. Average tax is nothing but total tax divided by total income into 100 to convert it as a percentage. 61,360 is the total tax. 7,45,000 is the total income. Into 100 will give me the percentage. 61,360 divided by 7,45,000 as a percentage. Whichever is less into doubly taxed income, nothing but 1,10,000 into 8.24 percentage. Nothing but doubly taxed income is 1,10,000 into 8.24 percentage. Okay. Therefore, tax payable after relief. Therefore, tax payable after relief is 52,300. Patiently take down. So, please compute as a percentage which is less and then apply it on doubly taxed income. Income which has already been taxed outside India, now taxed in India. Question number 2. Madan provides you the following particulars. Income from India from profession, interest from savings bank. This enjoys a small exemption under 80 DTAA to the extent of 10,000. Dividend income. Income earned from country A. Royalty income from patent, expenses on earning such royalty income. This enjoys a 3 lakh deduction under 80 RRB. 80 RRB. Rental income from house property in country B. House property chapter says the basis of computation will be the same as if the property is located in India. Repeating, house property chapter says the basis of computation is the same as if the property is located in India. Standard deduction at 30%. For house property, for income, I will get a standard deduction of 30%. Summation of income, house property 8,40,000, business or profession 42,10,000, other sources 27,05,000. deduction under Chapter 6A, 80 RRB, royalty from patents. Actual royalty, which is 8 lakhs, maximum limit 3 lakhs. So we can claim this 3 lakhs. DTAA, interest from savings bank account. If it is savings bank account, I get a small deduction of 10,000. Computation of tax. There is nothing which is taxable at a special rate which is there. Everything is taxable. There is no Ltcg, Stcg on which STT is paid or winnings. So everything is taxable only at normal rates. Base tax. This minus 10 lakhs into 30% plus 1,12,500. 64,45,000 into 30% plus up to 10 lakhs, it is 1,12,500. Repeating, 64,45,000 into 30% plus up to 10 lakhs, it is 1,12,500. So I'm getting 20,46,000. Surcharge because income exceeds 50 lakhs but does not exceed 1 crore, which is relief under section 91 from country A. Actual tax percentage in country A. Actual tax percentage in country A is 15%. Average tax, which is total tax divided by total income into 100, that is to convert it into a percentage, 234624 divided by 7445 into 100, nothing but this divided by this as a percentage. Okay, whichever is less into doubly taxed income, nothing but royalty that is doubly taxed is 9 minus 1 minus 3. Royalty that is doubly taxed is 9 lakhs originally the royalty minus 1 lakh the expenses minus 3 lakhs the deduction that is claimed. So 5 lakhs of royalty into 15%. In examination tension, we should not put 9 lakhs or 8 lakhs. We should find out income doubly taxed. Entire 9 lakhs is not doubly taxed. Only to the extent of 5 lakhs it is doubly taxed. So 5 lakhs into 15%. Repeating, in examination tension, please don't understand this as 9 lakhs. There is an expense of 1 lakh, so that is not taxed. There is a deduction of 3 lakhs that is not taxed. So what is included in 74, 70, 45 is only 5 lakhs of royalty and not the entire 9 lakhs. So 75,000 from country B. Actual tax rate is 28%. Actual tax rate is 28%, which is lesser than the average tax rate. Doubly taxed income is again only this 8,40,000. Because you have claimed from standard deduction, only 8,40,000 becomes doubly taxed income. Okay, so 8,40,000 into 28%, because that is the least. 8,40,000 into 28%. Base tax calculation goes like this: 74,45,000. So 64,45,000 into 30% plus 1,12,000. Here he is not a senior citizen and all. So up to 10 lakhs, 1,12,500. How I got it? Up to 250 nil. 250 to 5,12,500, that is 5%. Next to 5 lakhs, 20%, 1 lakh. That's how I got it. Yeah. Where there is a DTAA with a country in respect of taxability of a transaction, can a taxpayer choose to be governed by the normal provisions? Can the department insist that the provision of DTAA should be applied? No. Whenever there is a DTAA, the taxpayer has the option of choosing either normal provision or DTAA, whichever is more beneficial for him. The department cannot insist that he should go only by this. Whichever is more beneficial can be, whichever method is more beneficial for the assessee can choose that method. Okay, there is no problem. What is foreign tax credit? To whom it is applicable? We discussed this just now, so I am going to the theory answer. According to section 90, the provisions of DTAA will apply to the extent they are beneficial to the assessee as compared to normal. Therefore, it is clear if a taxpayer feels that it is not advantageous, he can ignore the provisions of DTAA and go by normal provision. Foreign tax credit. Rule 128 of the income tax rules specify on foreign tax credit. According to the said rule, an assessee who is a resident shall be given a credit of an amount of any foreign tax which is paid by the assessee outside the foreign country, outside India. Such credit will be available in the form of deduction or otherwise in the year in which the income corresponding to the tax credit is accounted. FTC includes tax, surcharge and cess. FTC does not include interest and penalty. Further, it will also include any sum of foreign tax or part thereof. It will also not, which is disputed, I told you. To whom FTC is allowed? An assessee who is a resident shall be given a credit for an amount of foreign tax which is paid by the assessee or taxpayer in a country or specified territory outside India. Such credit shall be available in the form of, okay, whatever it is. In the case, in case the income to such tax over multiple years, FTC will also be claimed in the same proportion in which income is offered. Just now we studied that. Okay. FTC is a popular question, so please write that rule 128, only 5 points and you will get that. Niranjana, aged 61, senior citizen, has derived income from country X with which India does not have DTAA. The broad details of the income are business income in India 8 lakhs, business income from country X 6 lakhs, gross rent received for let out house. This is India only. This is only is foreign income. This is okay. No. Sorry. This is also not India. Life insurance premium paid 1 lakh. In country X, the rate of tax is flat 10% for income from house property. Okay, is flat 10%. Income from house property is not taxed in country X. I'm not bothered. For us, it will be taxed in the same manner as if the property is located in India. Compute the total income and the tax payable. Read through. For a ROR, the global income is taxable. For house property chapter, the mode of computation is very simple. As if the property is located in India, it will become taxable. There is no municipal tax and all given, so otherwise I would have deducted that municipal taxes also. Life insurance premium, which is coming under L80C, okay, is 1 lakh. base tax will be 6,36,000 into 30% plus 1,10,000. Remember, the person is a senior citizen. First 3 lakh 0, next 2 lakh 5% 10,000, next 5 lakh 20%. Okay, senior citizen. HEC at 4%. Total tax before relief less relief tax rate outside India. What rate it is? Okay, 10%. Okay, tax rate as a percentage outside India. Average tax nothing but 3,12,832 divided by 16 lakh 36,000 into 100. So we see 10%, whichever is less into doubly taxed income, which is only professional income, because HP income is not taxed outside India. Okay, that country does not tax HP income. So only the professional income of 6 lakhs into 10%. Only the professional income of 6 lakhs into 10% will be applicable. This into 10%. Question number 5. Strawberries Private Limited, a domestic company, has derived income from India as well as country X with which India does not have DTAA. The following are the income: gross rent, municipal taxes paid, own business income, share of profit of a firm, agricultural income. In country Y, municipal taxes are not allowed as deductions. So what? We should compute as per the provisions of our law. For a ROR, in the case of company resident, property located outside India will be taxable, and the mode of computation is as if the property is located in India. So municipal taxes will be allowed. Agricultural income and share income of firm in country Y are exempt in that nation. The income tax rate is flat 25%. Ascertain the income tax payable. Read through. House property located in India. Gross rent or GAV is 12 lakhs less municipal taxes paid 40,000. NAV is 11 lakh 60,000. Standard deduction at 30%. You cannot combine and put because this we might require. Share of profit from a firm exempt under section 10 subsection, be it Indian firm or foreign firm. The law says share of profit from a firm is not taxable because the firm would have already paid the tax. Share of profit from a firm, okay, in that country or our country, it is not taxable. Okay, exempt both for domestic firm and NR firm. Other sources. Agricultural income from outside India. Agricultural income from outside India is taxable 2,41,000. Agri income from India exempt under section subsection 1. It is not taxable. It is exempt under section 10 subsection 1. Gross total income. Since there are no deduction, this becomes the total income also. computation of tax. Base tax at 25%. Assume that the company's turnover does not exceed 400 crores in financial year 18-19. So let me take it as 25% and HEC at 4%. Yeah. I was expecting a question. I'm very happy you all understood, and so I believe that there is no question like that. It is a company, no aggregation of agricultural income. Otherwise, if it is an individual, you know how I would have worked the tax, including agricultural income, excluding. That is only for individuals because there is a slab rate. For companies, the Indian agricultural income is totally exempt. There is no indirect method of taxation. So I'm happy. I was expecting that question from you, but none of you asked. So I will take a favorable assumption that you all understood. In countrywide, municipal taxes are not allowed. Agriculture income for this, if it is examination question in exam, write the theory, okay? Even though it is not taxable, even though it is not allowed, but according to the resident assessee, it will be computed as if the property is located in India. Agriculture income and share of income are not exempt. So it is only on the business income, this 25%. Okay, fine. Tax rate outside India, 25. Tax in India, we all know 26 because 25% base tax plus 4% surcharge on 25 makes it 26%. If you want, I will work out and show you. It will be 26. Whichever is less into doubly taxed income, that is only the business income. That is only the business income. So the doubly taxed income here is 7 lakh, 11 lakh 20,000 into 25%. Thanks for correcting. There is one mistake I did. Doubly taxed business income and IHP. Okay, the gross rentals of other country is taxed. Thanks for correcting. So it is not just business income alone. It is 25% of business income plus IHP. You are right. Okay, it is only agriculture income and share of profit that is exempt. So 3,99,000 plus 11,20,000. These two into 25%. Okay, so it will be. You are right, friend. I stand corrected. It is business income plus house property, 3,99,000 plus 11,20,000 into 25%. Into 25%. That is correct. Mala, a resident aged 56 years, derived income of 15 lakhs from a business in a foreign country. She paid tax at 25% on the above. She has a rental income of 12 lakhs from a let-out property in Mumbai. Interest on money borrowed for acquisition of the house property is 90,000. The government of India does not have any agreement. Okay, I leave this question to you. Okay, you can. Okay, so it will be 12 lakhs minus 30% standard deduction minus 90,000. That will be the house property income. That will be the house property income. Okay. Okay. 12 lakh minus 360 minus 90. Income from outside India. So whichever is less, very, very simple. So I'm not taking out your time for this. You can work out and see. Okay. I know you can. Okay. The next question I will work out. Ramesh, aged 61, an individual resident in India, furnishes you the following particulars of the income. He earned income in country M and India has not entered into DTAA with that country. Income from house property in country M, business income in India, dividend from company in country M, royalty income from country M, business income in country M, income from house property in India, donation to PMNRF, medical insurance for mother, rate of tax in country M. Ramesh disputed royalty income in country M but paid the tax on that income in June 2020 after the appeal was decided by the appellate authority. The royalty income is charged at a concessional rate of 15% in country M. Read through. I'm writing some preliminary aspects. Okay. Since what is provided is income from house property, it is assumed that standard deduction and other allowable deductions are considered. So I will, as it is stated, we will assume that standard deduction has been, because they have not given it as rent, they have given in the question as income from house property. Okay, both the cases we consider. So royalty, the tax was disputed. Normally when the tax is disputed, the tax credit, which is nothing but relief, will not be provided. However, since the judgment is against the assessee and delivered in June 2020, the same should be considered and relief provided. Okay. If the judgment is June 2021, no, I would have provided only that. Since it is provided in June 2020 itself, I can consider it. But normally when the tax is disputed, you will not provide FTC. Foreign tax credit will not be provided. Foreign tax credit will not be provided. Sir, will income be taxable? Yes, yes, yes. For ROR, global income is taxable. That is not under dispute. That is not under dispute. Dispute is whether tax has to be deducted. So, income will be done. House property from India. How much is that? Income from house property in India, 5 lakhs. From country M, 2,50,000. Business income from India. Business income from India, 8 lakhs. From country M. From country M, 2 lakhs. From India. Okay. Dividend income from country M, royalty from country M, income from, okay, from India is nothing, from nothing, okay. Dividend from country M, dividend from a foreign country, 1 lakh, royalty from country M, royalty from country M, 4 lakhs. Business income, income from abroad. Okay, okay, good. Gross total income. Deduction under Chapter 6A. $80D, medical insurance for parents, okay, senior citizen. So obviously I can claim up to 50,000. If they have given it as non-resident only, 25,000. Parents non-resident means 20. Here I can claim 50,000. 80D, donation to PMNRF, Prime Minister's National Relief Fund, 50,000. 80 RRB, royalty income. Okay, I am writing here, provided it is registered and other conditions satisfied. Okay, we always make this a deduction. 3 lakhs, up to 3 lakhs. If the actual royalty is less, that only, but here it is 4 lakhs, so 3 lakhs. $18,50,000 is my total income. 18,50,000 is my total income. There is no LTCG, STCG on which STT is paid, or lottery income. Okay. Computation of tax. Remember, he is a senior citizen. He is a senior citizen. Base tax will be 18 lakh 50 minus 10 lakhs. So 8 lakh 50,000 into 30% plus 1 lakh 10,000. 8 lakh 50,000 into 30% plus 1 lakh 10,000 because he is a senior citizen. So I'm getting 365 plus 14, 379, 600. This is total tax before relief. Relief under 91. Okay, what is that? Okay, rate of tax in the other country is 20%. Rate of tax in the other country is 20%. For royalty, 15%. Average tax, how much is that? 379,600 divided by 18,50,000 as a percentage. Okay, so average tax is 3,79,600 into, sorry, divided by 18,50,000 into 100. So average tax is more than 20% and more than 20%. So in both the cases, the foreign tax is less. In both the cases, foreign tax is less. Okay, foreign tax is lesser in case of royalty as well as other income. So for other income, which is nothing but what are all the other incomes which are included? Okay, 2,50,000 and 2 lakh from 4,50,000 and dividend of 1 lakh, 4 lakh 50, 5 lakh 50,000. Okay, repeating, 2 lakh 50,000 plus 2 lakh plus 1 lakh of dividend is into 20%. Repeating, okay, please understand this 2,50,000 plus this 2 lakh of business income plus this 1 lakh into 20%. Into 20%. For royalty, 1 lakh into 15%. Why 1 lakh? Because the doubly taxed income, I have claimed a deduction of 3 lakhs 80 RRB. So it will be 4 lakhs minus 3 lakhs which I have claimed into whichever is rate is less, so 15%. Okay, total tax after relief. Okay, okay, right? I'm honest to you that I'm working as many questions I will work on a regular class. In fact, regular class I make others work, but here I'm working because hit that straight on the eye. That is, if it is 5 marks or 6 marks, we'll get that back, that 6 marks from DTAA. Question number 8. Income Tax Act provides for taxation of a certain income earned in India by Mr. X, a non-resident. The DTAA, which applies for Mr. X, provides for taxation of such income in the country of residence. Is Mr. X liable to pay tax on such income earned by him in India? No. Wherever there is a conflict, wherever there is a difference between the law and DTAA, that which is more beneficial for the assessee shall prevail. In the given case, Mr. X is liable to pay tax in the country of his residence. It is natural. He has to pay tax in the country of his residence. It is better for him to avail the exemption benefit in the country of source, because DTAA says that it will be really beneficial for Mr. X to avail it in the source country. Okay, hence he is not liable to pay tax. Examine the correctness or otherwise of the following statement. The DTAA entered into by the government override the domestic law to the extent it is beneficial to the assessor. It overrides the local law, no doubt about it, but to the extent it is beneficial. To the extent it is beneficial, it overrides the domestic law. To the extent it is beneficial, it overrides the beneficial domestic law. So remember this, that it overrides the domestic law. Okay, that remember foreign tax credit fully the theory, and remember how questions has to be. This is a clubbing, always with assessment of individual they can club this and ask a question. We are going to study assessment of individual separately, but now I am very happy you have a reasonable idea about how to claim a credit. So in the 30 marks, I have completed 20 marks. 5 marks belongs to BEPS and model tax convention. Let us come to it last. Let's come to it last. Actually, the lectures are also available in the YouTube. Okay, it's an open lecture. Okay, let's come to it last. Okay, if time permits, we will do. Otherwise, you can refer to that. It is a full-fledged 2 hours lecture I have given for both BEPS and Model Tax Convention codes. But if time permits, definitely I will redo it for you people. Okay. So that will be 5 marks. The remaining 5 marks can be either advance ruling or equalization levy or a combination of two. Okay, not necessarily 5 marks, 2-3 marks also. Advance ruling is recently not tested much, so it can be equalization levy. There is an amendment, so there is a possibility of a question. There is an amendment in equalization levy, so the possibility of that question increases if there is an amendment. Otherwise, okay, advance ruling. Knowing in advance so that disputes are stopped. Knowing in advance so that disputes are stopped. My dear friends, we have already seen this same principle in APA. We have already seen in advanced pricing arrangements, agreements, the same things. Entering in advance so that future disputes are not there. So almost it will be like a mirror kept in front of APA. Almost majority of the provision it will reflect here also. Majority of the provisions it will reflect here also. Let us try to understand. Advance ruling is to avoid unnecessary litigation and to develop a relationship with the taxpayer. Assessee can in advance know his tax liability as well as income. Okay. The first and foremost question of advance ruling is who can apply? A non-resident might not be very familiar with our income tax law. Even residents are not familiar. Even chartered accountants are not familiar. You and I personally know, but let's come back. A non-resident is not very familiar with our income tax law. So, for him, this is very essential. First, listen. A non-resident can apply. A resident entering into a transaction with a non-resident. A resident entering into a transaction with non-resident can also enter to know the liability of the non-resident, not me. To know the liability of the non-resident. Any notified authority, public sector undertakings can apply. Slowly the law is opening out for residents also. Two residents entering into a contract can also apply for advance ruling if the contract transaction value is more than 100 crores. If the transaction value is more than 100 crores. So transaction based. Slowly. Non-resident in relation to a transaction proposed to be undertaken. Either he has already undertaken, it might be even with the assessing officer, or he is proposed to undertake. He is proposing to undertake. Resident, when he can apply, entering into a transaction with a non-resident, not for resident, only with the intention of knowing the tax liability of that non-resident. Not about me. It's about him, sir. You tell him, not, I am an applier, but it is for him. Resident, in order to obtain the tax liability which he has undertaken already or proposed to undertake. However, the transaction value should be more than 100 crores or more. Public sector undertaking, and you can also check whether an agreement is an impermissible avoidance agreement. On the question whether an agreement is going to be declared as IAA, about that I will speak in assessment procedure class 1. Okay. So can I repeat who can apply? Non-resident. Resident entering into a transaction with a non-resident to know about the income and tax liability of the non-resident. 2 residents entering into transaction 100 crores or more, public sector undertaking, and to check whether a transaction tomorrow will be declared as impermissible transaction, GAR, General Anti-Avoidance Regulation. Make the application. This is not a question. The next question comes here. What is the procedure for applying? I have received the application. On receipt of an application, AAR stands for Authority of Advance Ruling. Once more, AAR stands for Authority of Advance Ruling. Will forward the copy to the commissioner and call upon the commissioner to furnish records. I will tell the commissioner, look, this non-resident has applied to me or this resident has applied to me. Please make some inquiry and get back to me with the reports. The authority may, after examining the application and the records, allow or reject the application. If they feel that the application is not proper, they will reject it. Otherwise, they will allow it. Okay? Right? Remember, applicant can also withdraw within 30 days. The applicant can also withdraw within 30 days, or they themselves can reject also. When will they should mandatorily reject? Once more, when should the AAR reject the application mandatorily? 3 circumstances. If the matter is already pending with some income tax authority or appellate authority. We start this in APA also. There they will withdraw the appeal and put, but here you cannot. If the matter is already pending with an income tax authority or a appellate authority. If it involves determination of FMV of a property, because for that the valuation officer is there. Why are you coming to me? Go to valuation officer, he will do that. Or you are putting the question in such a way that it results in tax evasion. In these 3 circumstances, the application will be rejected. Once more, matter pending with already is pending with an authority or an appellate authority. Matter is determination of fair market value. Matter relates is such a way prima facie it is for avoidance of income tax. You have made the question in such a manner. In these cases, I will reject. Otherwise, I will take it forward. But you can withdraw within 30 days. After 30 days, you cannot withdraw. APA is not like that. Till the agreement is entered, you can, because there is something known as pre-filing consultation. Consultation, we can just go off. I'm not happy, but here such procedure is not there. No application should be rejected unless assessee is given an opportunity. Where application is rejected, reason should be given, and where application is taken up. Where application is allowed, authority, after examining such further material as may be placed by the applicant or obtained by the authority, pronounce it advance ruling. So one of the questions they'll ask, can the AAR call for books of accounts and inspect? Yes. Here is the power. The authority after examining such materials may be placed by the applicant or obtained by the authority. The authority can also ask for books of accounts, documents, etc. Okay, so not necessarily that they can that only the assessee should present, or not necessarily see the application and do. I can inquire, I can go further into the matter. APA, similar manner. On a request received from the applicant, the authority shall, before pronouncing, provide an opportunity to the applicant, either in person or through this honest person called chartered accountant. The authority shall pronounce its advance ruling within 6 months from the receipt of application. Within 6 months from the receipt of application. A copy of the advance ruling pronounced by the authority, duly signed by the members and certified in a, shall be sent to the applicant and to the commissioner. So can we quickly see? Application is presented within 30 days, you withdraw. I will send a copy to the commissioner to make further inquiries. On the basis of his report, I can again reject or I'll allow. If I reject, I will ensure I will give you an opportunity to be heard, to represent, and the rejection report will be sent to you and the commissioner. If I allow, then I will call for further records. Either you yourself can give or I can call for further records. Within 6 months, I am supposed to pronounce my advance ruling. Before pronouncing, if you want, I will give you an opportunity again. You can represent. After that, I will pronounce my advance ruling and give a copy of it to you, the assessee, and the commissioner. This is final. Don't go on an appeal against my order. The coming to me itself is to stop appeal. Don't go on an appeal to against my order. Applicability of advance ruling. Applicability of APA on the applicant who had sorted. There also, we saw if there is an amalgamation, can the transferring company get only on the applicant who sorted? Here also. In respect transaction specific, in respect of the transaction for which he has sought. In APA, we remember that I have been telling to hold on to a word called critical assumption on the income tax authority. So, same manner on the applicant, on the income tax authority for the transaction which had been sought. Advance ruling will continue unless there is change in law or fact. Same. When is APA void ab initio? When is advance ruling void ab initio? Where the authority of advance ruling later finds out that the applicant has obtained it by fraud or misrepresentation of fact, then the order shall be declared void ab initio, the ruling becomes void, all the provisions of that same verse. Ditto. Okay? Okay? That's why I say it's not very popular. Quickly read through this. Quickly read through, we'll go to the questions. Shall I? Yeah. Question number 1. Q, a non-resident, made an application on 2/7/20 in relation to a transaction which he is proposed to undertake. On 31/8/20, he decides to withdraw. Can he withdraw? The answer is no. The answer is no. Application has to be withdrawn within 30 days. Beyond 30 days, the assessee does not have the option of withdrawing the application. Beyond 30 days, the assessee does not have the option of withdrawing the application. However, AAR can reject. Applicant, what in practical cases will do is ask AAR to reject it. Okay, so that is possible. All these answers are there. You listen this once, that is enough. So application cannot be rejected, cannot be withdrawn by the applicant. Okay. Examine when an advance ruling pronounced by AAR can be declared void, where the ruling has been obtained by fraud or misrepresentation of fact. Where ruling has been obtained by fraud or misrepresentation of fact, then it shall be void ab initio. So it will go back to the state of as if no ruling has been pronounced. Where the ruling has been declared void, all the provisions of the Act will apply as if the ruling has not been received. Mr. Balaram is a non-resident. The appeal pertaining to AY is pending before an income tax appellate tribunal. The issue involved being computation of export profit and tax thereon. The same issue persists for the next assessment year also. Mr. Balram's brother Krishna has obtained an advance ruling from the AAR for an identical issue. Mr. Balram proposes to use the ruling. Advance ruling is binding on the assessee who sought it, on the transaction which he has sought, and on the commissioner or income tax authority of that assessee. Another assessee, even though identical facts are there, another assessee, even though identical facts are there, cannot use it. APA once entered is only for that assessee. After amalgamation, can the transferee company use it because the same transaction? The answer is no. Similarly, advance ruling also no. It is only for that particular assessee. So, you cannot use it. Only one benefit. In the court, you can quote. In appeal process, you can quote. One other case was like this. In advance ruling, they pronounced. Like that, a reference can be made. A reference can be made. That is always possible. Sir, in a similar ruling in Bombay High Court, Delhi High Court, in a similar ruling by advance ruling, like that you can refer, but you cannot use it or you cannot compel the authority. The answers are there. I am just giving you the answers. Discussing the answers so that it is more clear. AAR has the power of compelling production of books of accounts. Yes, I just told you. AAR has the power to go through documents which are produced by him or produced to him or obtained by him. So they have power to call for documents, examine records, books of accounts, etc. They have all the powers. It cannot be stopped. Yes is the answer. This is a famous case law called Ericsson Mobiles. Twice this question, this Balram question and this question, twice it has come in our income tax law. Yes, sir, in our DT fine. An Irish company entered into a contract with an Indian company for provision of technical know-how and made an application to the AAR for advance ruling on the rate of withholding tax on receipt of Beta Limited. Beta Limited also made an application to the AO for determining the rate at which tax needs to be deducted. The AAR rejected the application of the foreign company on the ground that the question is already pending with an authority. Is the rejection justified? The law changed from 2020. Now the rejection is not justified. Please read this part alone, okay? In your now I'll explain you, but now I'm telling this because I have given the whole answer like suggested answers. Suggested answers has given what is before 1466 2000. That is not essential before $1. Now you can do that, okay? This is a very famous decision in Ericsson Telephone Corporation, where they said there are two different assessees. Please understand, there are two different assessee and one's application is different from another. The foreign company want to know their tax liability. For the resident assessee, they are seeking what is the TDS because 100%, otherwise the expenses will be disallowed. If they wrongly deduct tax, they will result in a disallowance of 100%. So their interest is knowing for a different purpose, and the other foreign company's interest is knowing for a different purpose. So yes, the application cannot be rejected. The application needs to be accepted. This is Ericsson Telephone case. Please quote that case alone. That is more than sufficient. Please quote that case alone. That is more than sufficient. You cannot reject the application. The same question only is May 2019. Same question. Okay. So May 2019 and the previous one was the same question. Now I will give you a brief answer for this May 2017 question, but you will understand it more clearly when I teach you the administrative provision. Echo & Co. filed an application for advance ruling for 3 financial years with the authority. For the financial year, notice under 143(2) were issued to the assessee and subsequently before the date of filing application with AAR. Notice under 142(1) is also issued. So for 1 year, 2 notices are issued, 143(2) notice and 142(1) notice. For financial year 21-22, notice under 143(2) was issued before the date of filing, and notice under 142(1) along with questionnaire was served on the assessee after the date of filing. Can AAR reject the application that the proceedings are already pending? For 1 year, he cannot reject. For the other year, he can reject. For the year 1920, notice has been issued Okay, before the date of filing of application. Both notice under 143.2 and 142.1. So assessment has begun. It is with an assessing authority. Whereas for the financial year 21-22, this notice, this is the assessment notice which you will very soon see, is after the date of filing of application. Though 143.2 notice is there, but 142.1 notice is after the date. So assessment has not yet commenced. So in that year you cannot reject. For the financial year 19-20 you can reject. For 2021 and 21-22 you cannot reject because notice has not been if application has been made before it itself. Okay. In that year the question came. Now I have changed the years. Thus applying the principle on the case, the application cannot be rejected since the notice under 142.1 is issued after the date of filing, and it will not be treated that already pending. Okay. Okay. Whereas for the other year it has been issued. Okay. So unless you know what is 142, 143, you cannot understand. But you now clear that before the questionnaire, you cannot, you have to apply, get the application or accept the application. After the questionnaire, I accept, was you cannot. The term advance ruling include within its scope a determination by the authority of advance ruling only in relation to a transaction of non-resident. No, the applicant can be 5 different cases. The statement is not correct. A resident can also be an applicant for determining the tax liability of non-resident. 2 residents, 100 crores plus, public sector undertakings. So the statement is not correct. The statement is not correct. Applicant can be even a resident. Okay, this is the same case which we saw. Okay, so AR, you can see every May there was a question. May 17th, May 18th, May 19th. I don't think recently they have tested. Okay, keep it, and the questions are very, very similar. Simple, straightforward questions only. We can very easily answer. Am I clear to you? Okay. So advance ruling, 1 or 2 times reading, 15 minutes one reading maximum. So in a span of months, you read it twice, you will be through with it. The last part of the discussion for today and the first level of international taxation is equalization levy. Equalization levy. Okay. Why? Why? Because you have already studied this, which is just postponed by 1 year. Business connection means includes significant economic presence. And we saw something. Basically, for this electronic transactions, we are unable to find the source country. Everything happens at a cloud space. If you have seen the movie Social Networking or Social Dilemma, the servers are under sea also. The servers are under sea. Cloud. How will you ever determine the source? Biggest challenge, OECD taxation is difficulty in categorizing the nature of payment and establishing the link between transaction, activity and where it is taking place. The electronic transaction, e-commerce transaction. OECD recommended modify the existing definition of PE by including significant digital activity. We did this year, okay? We saw this year that it being done. Though it is postponed, the applicability of it, definition-wise, it is defined. I told you postponed by 1 year. So definition holds good. That's what I said. Virtual fixed place of business, we should categorize that and put a withholding tax, and that is what is known as equalization levy. As soon as OECD recommended it, India is the first country to put it. OECD recommended, India implemented because it brings revenue. And interestingly, all of us in the classroom has to understand this is not Income Tax Act, this is there in Finance Act. This is not there in Income Tax Act, this is in Finance Act, section 165, 165A of Finance Act. When you write in a hurry, don't write it as Income Tax Act, it is in Finance Act. Equalization levy is not part of income tax, but it is part of Finance Act. Okay, what is it saying? Two sections. Second section only getting more importance, questionable area for your examination, in my opinion. Section 165, Equalization Levy on Specified Services. Payable by a person resident in India, carrying on business or profession, or by a non-resident who is having a PE in India. Once more, who is responsible for equalization levy under 165? Resident carrying on business or profession, or by a non-resident who is having a permanent establishment in India. If there is a resident who is paying to a non-resident but not having any business or profession, no equalization levy. Very famous example people give is matrimonial advertisements. I can even say sale of property. Non-resident is there, he wants to sell the property, he gives a not a business, no equalization levy. Applicable only for resident assessee carrying on business or profession, or non-resident having a permanent establishment in India. If no business, no equalization levy. Applicable only if the value exceeds 1 lakh. Equalization levy is at the rate of 6% on the amount of consideration. So it is like TDS, reduce and provide. 6% on the amount of conversion. For what services? Online advertisement, digital advertisement, both only are now there. No other services are notified. Online advertisement, Google AdWords, Facebook, everybody started in India because of equalization levy. provision of digital advertising space or any other facility. This is interesting. The whole thing is an amendment. Possibility of question is there. Possibility of question is there. Okay. Equalization levy on e-commerce supply or service. Such services may be provided. Here, the provider of the service. There, it is for the receiver. Here, 165 is for the receiver. 165A is for the provider of the service, not for the receiver. Bharatwaj Institute gives an online advertisement. Bharatwaj Institute is liable for equalization levy. A foreign website is making e-commerce transaction in India. The buyer, though I am the payer, I am not liable. That website person is liable. Services may be provided to a person resident in India, to a non-resident for sale of advertisement which targets customer. We have read this. So instead of bringing it as business connection, they are bringing it along with equalization levy. Who is a resident in India or a customer who accesses the advertisement through internet protocol address located in India. To a non-resident for sale of data, data collected from a person who is resident in India or a person who uses internet protocol, buys goods or services too. So the same thing, and the liability is on the service provider. Service provider who is not having, if he is having a permanent establishment in India, no problem, sir. He is not having Alibaba. Majority of the Chinese websites, they are not having permanent establishment, but they are catering to Indian customers. They are trying to sell the product to Indian customers. They are using the Indian protocol address. Make them liable to pay the tax. Had they earned the income, on the income tax, they would have paid 40%. Now make them pay on the turnover. Automatically, they will start their PE in India. Majority of the portals, which are operated from a safe haven territory, are not getting registered in not only India, any of the countries, but they are delivering goods. If you want to deliver goods, somebody should be here to deliver. So, you are advertising to the Indian customers, you are collecting data from the Indian customers, you are using the IP of India, but you are not paying taxes, saying digitally, you are, sir, I don't have a PE in India, or I am not at all in India, I am located in Mauritius. Here comes the problem, and I am making them now pay on the turnover, the tax. So, services provided to persons in India, you and me, or advertisement which targets you and me are using our IP protocol. How many advertisement comes if you open your Facebook? You all know. If you open your Insta, how many advertisement comes? You all know. Collection of data or goods, etc. Equalization levy will be 2% of the consideration received or receivable. 6% of consideration here, but here it is only 2%, 165A, and only by the provider. by the e-commerce operator, not by the utilizer, by the operator. There it is, utilizer. Bharatwaj Institute gave the advertisement. Bharatwaj Institute is liable to pay. Here, the e-commerce operator who is targeting the Indian customers. However, I don't want, you are unable to start in India because you are a small player, I want to exempt you. If the turnover of that company is less than 2 crores, taking the TT buying rate and apply and see if it is less than 2 crore, leave them. If the e-commerce operator has a PE in India, I will not tax you. If you are already covered under 165, I will not tax you. If you are a small service provider, I will not tax you. 165A is a questionable area. 165A is a questionable area, my dear friends. Okay? Theoretically only, not practical. Theoretical questions can come in 165A. Administrative provisions. Time limit for limiting, okay? 165 is like our TDS. 165 is like our TDS on or before 7th of the subsequent month. 165A is like TDS returns, but the due 7th of quarter. Every quarter wise you pay. I don't want you to pay every month. You pay every quarter on or before 7th of the month following the quarter. April, May, June, paid 7th July. July, August, September, 7th of October. MCQ. According to section 170, if there is a delay in payment of equalization levy, interest is 1% for every month or part thereof. TDS 201 interest, 1% or part thereof. Annual statements needs to be filed, e-statements, before 30th June, and you can correct it, etc. Penalty will be like this. In case there is a failure to deduct, okay, penalty shall be equivalent to equalize 6%, whatever it is. Where it is deducted but not paid, 1000 per day, 100 for TDS. You remember 234E, 100. Here it is 1000. If there is a failure to furnish annual statement, rupees 100 per day. Again, might be useful for our objective types. 165A, please be clear about 165A. It is on the service provider. You can link it and study it along with your business connection, new amendment. The same wordings will be there. So I'm trying to collect it. If you don't have a PE, I'm trying to collect it. If you have a PE, business connection is established, it will come under PGBP. If you don't have a PE, I'm trying to collect it as equalization levy from the service provider, e-commerce operator. First part, these are just what is meant by permanent establishment. I told you everything, case of management, branch, office, factory, workshop, sales outlet, everything. Okay, so the first part of our international taxation is over here. With only the last BEPS and the model tax convention code dependent on the time. Please wait. Please wait. I have something to discuss with you. So the first part gets over here. I have something to show you. I haven't included for this for one big reason that I want to show you. This is our July 21 question paper. This is our July 21 new syllabus question paper. Old syllabus was because people say that this was difficult. I will answer every question of it. Okay, don't worry. To see, I hope it is visible. Mr. Ram, a citizen of USA, resides in USA. He is a non-resident since assessment year 45. He works for X Incorporation, a US-based company. He came into India 10th June to visit his parents. He could not return back. He could return back only on 31st January 21. So April to January he was here. He was permitted to work from his home by the Indian employer. The details of his earning for withholding of tax for the period is given below. His salary, people immediately got very much worried. You know how to answer this question. His salary, federal tax, this is only income tax. Status tax or social security tax are not income tax. Foreign tax, because the FTC was amended to say income tax only should be given. So you need to just multiply it. He also earned FD interest in USA that is not taxable in India. According to Article 22 of DTAA, the tax covered for credit or federal income tax imposed by the revenue. They themselves has given. Return, you are required to compute the tax payable by Ram, assuming that he has opted for 115 BAC, that I will work out and show you. Advice on the foreign tax credit. Only on the federal tax he can claim. But if the question has some other trick, it is only one thing. There is a notification issued by CBDT. If you are stuck in India due to COVID, that period you will not be counted and you will be taken as a non-resident only. In which case, nothing is taxable in India. Because it is a COVID year, I don't know whether the intention is so. I have to wait for the suggested answers. He came to India 10th January. So 21st March 2020, lockdown announced. Okay. And we never had flights traveling. So if he is stuck because of that, no problem. He is continuing to be a non-resident. This period will not be counted. Otherwise, he will be a RNOR. Otherwise, he will be a RNOR. For him, income received in India is only taxable. Suppose if this salary is received in India, then also he will get the foreign tax credit. Okay? That is the only thing we have to wait and see in the question. Otherwise, a very simple question, but looks very lengthy. I will work out if you want. When I do 115 BAC, I will work out and see. Look at this question. Cherry Limited, a non-resident German company, has the following income in India. Dividend income, which we all know is taxable. 8% debentures received from X Limited, an Indian company, on October 1st in consideration of providing know-how. So, this is a old question. Can I change this Cherry Limited into Red Limited? You got the answer already. We worked yesterday. If you change this Cherry into Red, we know this 20 lakhs is also taxable. 8% of 20 lakhs into 6 by 12. Dividend received on GDR, 10%. Issued under a scheme of central government, etc. Business income, normally taxable, 40% because foreign company. Income by way of royalty other than 44DA. So 115A, 10%. As per the DTAA between two countries, such royalty is taxable at 12%. Either the law or DTAA, whichever is beneficial. So I will take it 10%. Why will I go by this? With a brief reasons, you are required to compute the tax liability. Very simple. We know this question. We worked out in a different manner. One third and fourth question, if they club, they will give you, they will get one other question. That's how the institute operates. Okay. Mr. Naveen, a resident individual, earned 15 lakhs royalty from XY Incorporation of Canada for writing articles of journals, etc. However, he received only 12,50,000 and the balance is outstanding. He maintains cash system of accounting. He also earned the rental income from a house located in Canada. MT is 10,000, which is not allowed as deduction. That's not a problem. We can allow. DTA between Canada and India provides 15% without prejudice to the taxation, same India. He further received 3.5 lakhs as dividend from X Limited, an Indian company. He took an educational loan for his son, which is 80E. Annual repayment, only the interest portion will be allowed, this 24,000. We just did. DTAA, we did. Because I feel it is not a difficult thing. I want to show you. I will show you. This is a question on yes, but the first point you just did. A notified infrastructure fund 1047 pays interest of 4.5 lakhs to a foreign company. The US company incurred expenditure. The fund also pays interest to a resident located in NJA. This is the same beast question which is repeated. For that US company, 5.2%. For the NJA, 30%. Same beast question repeated in a different manner, but it is coming under TDS. Okay? Look at this TP question. This is the TP question. Paras Limited is an Indian company engaged in the manufacture of supreme quality mink blankets. It has a total borrowables of 60 crores by way of loan. Suction Limited, a German company, imported 5 lakh blankets for the resale in Germany at 2,000 per unit. Paras Limited sold a similar blanket for 2,100. Paras Limited received a bank guarantee on 1/4/2020 for availing a cash credit of 9 crores from Suction. What is my total loan? 60 crores. What is my bank guarantee? 9 crores. More than 10%. More than 10%, they become associated enterprise. The terms of the trade for other dealers was to make 1 month credit. Here it was 3 months credit. Cost of credit is given. Only one adjustment. Are they, the question itself, I think they asked, are they required to determine whether they are associated enterprise? If so, the implication could have if yes, because obviously it should be yes, then only if yes comes. Compute the ALP of the transaction and the amount to be added back. Assume the adjustment of the have been made suo motu in its return. What is the time limit for repatriation money? 90 days from the due date of filing return. What are all the implication if excess money is not repatriated? 8 months. Excess money not a secondary adjustment, not made more than 1 crore. Okay, if it is more than 1 crore, if you don't do it within 90 days, interest has to be charged from the due date of filing return, otherwise pay the additional tax. Okay, okay, and I don't have the what do you call objectives. BEPS, simple question on BEPS, which we will see later. Okay, okay, this has been the question. Old was much more simpler. New was also very simple. I will answer every question if you want. But only thing at the end of it, because up to last year I have included in the material itself, this only thing I want to close with this. You just need confidence. It is not lack of preparation, it is lack of confidence that only will bother us, bring us down. Please be confident. International taxation will not go out of your hands. minimum of 20, by God's grace 25, we should be able to score, so that the other part of direct taxation is much more simpler. If you read the question twice or thrice, you will remember what the provision is. On reading length of the question, federal tax, status tax, people might become jittery. Actually, if you recollect FTC, you will understand. If you recollect the scope of total income, they cannot go out and ask anything. Be confident that we will not have any hiccups or hurdle in indirect international taxation. We will score the maximum. From tomorrow, our direct taxation part starts.